All right, colleagues, welcome back. As always, Scalping Trading School is glad to see you here. First, let's quickly check the connection. Guys, please tell me, can you see my screen? Can you hear me clearly? If everything is fine, please drop some pluses in the chat so I understand that we are good to go. Okay, yeah, I can see the pluses, perfect. Great, then let's get started. And yes, the recording of this lesson will be posted after the class, so don't worry if you miss something, you'll be able to rewatch everything. Today is actually an important milestone because after today's lesson, you will start trading. So congratulations to all of you. Today we are basically going to put the entire foundation together. We will go through entry algorithms, exit algorithms, risk management, and we also will break down the reversal or bounce strategy. In other words, today we are preparing you for real trading. Okay, if any questions come up during the lesson, no problem. Write them down and we'll discuss everything afterwards, okay? So for those who may be new, my name is Julia. Most of you already know me. Very glad to see you all here. And let's move on. Let's start by reviewing one very important concept. Last lesson, on the first lesson, we already went through it. But today I want to go a little bit deeper, and it is volatility. Let me write down. Volatility. Okay, we will quickly go through what it is and why it matters for trading. Okay, many of you probably know the ATR indicator, average true range. This indicator shows the average price movement range of an asset, meaning its average volatility over a certain period of time. But honestly, guys, if we simplify it as much as possible, we just compare candles. That's it, nothing else. So what do we need to do in order to measure volatility? It's actually very simple. We just take two candles and compare their size. That's all. We simply take a ruler and measure the candles. For example, let's take these ones. 143.49, and the next one 1 and 10. So almost the same. Right now we are looking at the 1 hour time frame, but honestly that's not the key point here. You can do the same thing on any time frame, the hourly chart or the 5-minute chart or any other, it doesn't matter. The main goal right now is simply to understand the principle. Okay, so as we measured here, let's do this again. So let's take this one, 143, and another one was about 130. Okay, so what does it mean? It means that, for example, this candle on Sunday 30 November at 9 o'clock it was 143%. This candle at 10 o'clock was roughly the same, so volatility was roughly the same. Okay, so let's talk about why this actually matters in real trading. Imagine you are already in a trade, and let's say here there is a level. We have a level, for example, let's say here, do it like this in green. So let's imagine that this is a level and this is where you enter the position. Here you enter the position. For a while we see that volatility stays roughly the same. Here, this candle, and this candle, it's roughly the same. The candles are about the same size. But what happened after that? Then something changes. Suddenly the candles start getting much larger. You see this one, this one. So if we measure it, here's the candle as we measured already. Here's the candle 143. Here is the candle 162. And what happens here? It's 289. And this one is already 8%. What does that tell us? It means the volatility is increasing sharply. And what happens? And when volatility suddenly grows like this, it tells us just one simple thing. The movement in the market has become much stronger. Okay, so let's say you entered a long position here. Here you entered your position long, in long position, and you expect the price to go up so you can profit from the move. But when you see that volatility suddenly starts increasing against your position here, in this situation, guys, the best decision is to close the position. So we close it here. Just exit the trade and move to another asset. We don't add to the position and we do not average down. Yes, technically you can add to the position and shift your entry point. But right now, we are not using that approach. Our rule is simple. We close the position. We close it here. Okay, and just move on to another asset. I think it's clear so far, right? Okay, but sometimes the opposite happens. You are in the trade, for example here, you enter the trade over here, and volatility starts increasing in your direction. That's great. That's exactly what we want. And in this situation, we should use it to our advantage. For example, you can trail your stop, lock in profits, take profit in parts like we teach, okay? Later today, we will go through a clear profit-taking algorithm and you will start using it in your trading. So just remember this simple idea. If volatility grows in your direction, that's a positive factor for your trade, okay? So guys, is this clear for so far? I think it should be clear. Okay, I'm talking about the difference, actually about the difference between volatility moving against you and volatility moving in your favor. If everything is clear, please drop some pluses in the chat that I understand that everything is clear. And if something is unclear, feel free to ask questions. Okay. Okay, that's great. Now, let's look at one more important point. We can measure volatility not only with a single candle, like here we did, but also over a certain period of time. For example, we take 10 candles. Let's do this like this. Let's take this, for example, 10. I want to take these candles. Let's take these ones. And what we can do, if we are on 1 hour time frame, that means we are looking at how the asset behaved over the last 10 hours. It's approximately 10 candles, okay? So we measure the size of each candle, then we add all the values together and divide by the number of candles. And this gives us the average volatility for this period. Using this method, we can compare different areas of the chart. Okay, so we, for example, we take 5 candles here, 5 candles here somewhere or here, and immediately we can see where volatility was higher. And guys, please pay attention to one more very important detail. When volatility suddenly increases, in most cases we also see an increase of volume. That's important. You can see here. You can see it here. What does that mean? It means that a strong participant has entered the market, or a large player has started exiting their position. In other words, any change of volatility gives us information about market sentiment. Okay, what do we do next? What we can do? We take a group of candles, measure them, and then make a conclusion and how the asset behaves during that specific period of time. That's the whole idea. I think it makes sense. Okay, one more important point. We can measure volatility not only inside one asset, but also between different assets. For example, let's take some other asset. Let's take this one, for example. In the moment, let's see here. Well, let's take this one, for example. Let's say here, this candle, this red candle, shows us 3.27%. And this is on 10th of March at 9 p.m. Okay, let's go back here and see what we have here at the same time. 10th of March, 10th of March at 9 p.m. it was, right? This one. This candle at the same time, like we measured it at AIXBT. So let's measure it here as well, this one. 2.3. So what we can see here, what does that tell us? It tells us that at the moment, AIXBT was significantly more volatile than VIF. Now the question is, why does this matter for us as traders? Because assets with different volatility require different trading approaches. That means different entry and exit strategies, different trading styles, and even stop-loss calculations will be also different. All of this directly depends on volatility. And you can see this especially clearly on pumping assets, assets that move very aggressively. Their volatility becomes obvious immediately, and we learn how to work with it instead of fighting it. Okay, now let's go back to the chart for a moment. Where? Let's see where we're writing. Right here. Okay. Okay. Actually, this is not a part of main topic today, but I still want to show it to you because I think it will be interesting. You will see how this works on pumping assets and why we actually look for these zones in the market. Many of you probably heard of Dawes theory. For example, here we can see that an uptrend begins. The asset starts rising and we get a steady upward movement. You see? And what appears during this movement? We start to see three phases of market movement. This is something what we are actively teaching now. This approach is called phase trading, a new and very powerful strategy. It is interesting and it is effective, and it gives a completely different way of looking at the market. But before we can properly use phase trading, we first need to clearly understand the phases of the market itself. Okay, let's take a look at this. Here we can see three phases of the market. Can anyone see it clearly? Maybe somebody can say what kind of phases we have here. I think it is visible for everyone. So here we had a certain market phases, right? So what is the first phases? Let's mark it. This is our first phase. Let me remove all these things. This is our first phase. Like this. Let's drop them down. And this called is accumulation phase or consolidation. This is where the big players operate. Think about it this way, because just imagine a large participant, for example, let's imagine he has $500 million. Let's say like this, $500 million. To deploy for his trade. Everyone understands that if he tries to enter the market all at once here, that's going to be a big problem. If someone doesn't understand, let me explain. If he suddenly buys 500 million worth of the asset right here, the price will shoot up immediately. He will move the market itself. And in reality, he won't end up buying here. His entry point will be much higher, and immediately his position will be in red. Immediately. So in order not to happen that, and large players know about that, the large players always accumulate gradually, slowly, calmly, buying the asset piece by piece, piece by piece. So here, the zone where the large participant is building his position. I want to label it in order not to be confused, okay? So let's write it down. Let's call it consolidation. No, let's write it like this, accumulation. Accumulation. This is a phase number 1. Okay. Accumulation. Okay. What do we have next? Next, we have phase number 2. And after that, phase number 3. Let's mark it as well, like this. And the third one is like this. Okay, first we had the accumulation phase. And then the asset moves into a strong impulse. Volatility starts increasing. And the price begins to move. Those of you who have studied this before already, they know this is when an impulsive trend starts forming. Yeah, we are not diving deep into trends today, but we will definitely work with levels during this lesson. So who can tell me what is this phase called? Anyone know maybe? Just write down the answers. Okay, yeah, I can see already correct answers. Yeah, participation phase. Absolutely correct. Absolutely correct. Let's write this down also. Second phase is participation. Participation phase. So this phase number 2. What happens during this phase? This is where the large participant starts pushing the asset upward. There is a certain moment when the big player begins actively driving the move. Later, when we study levels, you will start noticing where the biggest participants are positioned. Because actually our goal is to trade like the big players, to find their footprints in the market and move together with them. Okay, so the next phase, the third one, it is the realization phase. Different traders call it different things, but we call it realization phase. Let's write them down. Realization. Okay, what happens during this phase? The large participant starts taking profits. Yes, sometimes it can look like a long consolidation, but remember, we are currently looking at an uptrend example. The same thing happens in a downtrend as well. So these phases actually work in both directions, doesn't matter, long or short. So we have the realization phase. But we add one more important idea here. This phase is not always only about profit taking. There can also be another process happening at the same time. Let's see how it happens. I want to explain and show you. During the accumulation phase, he has, for example, let's imagine he has, as we say, $500 million. In accumulation phase, he might have spent around, let's say, 300 million. For example, let's write it here like this, 300 million. Okay? In order to build this position. He cannot deploy everything at once, as we say. It is not profitable. Yeah, because the participation phase also needs liquidity and support. And this is where the rest of the market joins in. Traders, hamsters, they all see the price rising, right? So it's not only me or you, a whole of the world, every trader. And everyone starts jumping in, buying the asset, and they help push the price higher. They basically help the big player move the asset to the level or percentage move that he needs. So during this phase, he might spend, well, let's say 100, let's say $100 million. For example, just to support this trend and keep the movement going. Okay, so the asset gets pushed higher and higher until it reaches a certain point. And that's when we enter the realization phase. And here in the realization phase, two things can happen. The first one, it's simply realization. The big player starts closing here positions, taking profits, and the price returns into some kind of range. Or the second thing which can happen here, it is a release of free margin. It's a little bit different. I will explain now the difference between this. Let me write first down this realization and let's say, release of free margin. Let's write this like this. During this phase, the big player might start freeing up margin while the realization process is happening. Why would he do that? Let's say he still has 100 million left. Here is $100 million. Okay, but he wants to push the asset even further. To do that, he needs more liquidity and more margin. So what does he do? He buys the asset here, and then he starts selling part of it higher, collecting his USDT back. This allows him to free up resources and prepare for the next movement in the market. Okay? So I think this is also clear about the phases, right? So what happens actually next? Let's see. Let's take a look at how the asset actually moved here. Let's see. What happened here? First, the big player let the asset drop. You see here? Slightly down. Then the price stays here for a while. This is where he was freeing up margin. Okay? We can see it here. It's freeing up his margin. He let the asset slip down a little bit more. And then suddenly, what happens? He pushed the price sharply upward and then simply left the market, you see? So we can even like this, we can mark it like this. You see what happens? He tried to push it again, and then he just exited the trade, just left the market. At that moment, it was already clear that he was exiting. He tried one more push here, but this also suggests something important. Actually, there could be another big player, right? So if you can see, they could be a big player here also, right? So there could be another big player sitting above here, right? Holding the price from the top. That's why he had to come out from the position. You know, guys, actually, it's very important to see these phases. For example, you need to learn to see these steps, you know, these phases. You need to recognize them and understand what exactly is happening in the market. I want to show you something right now. Most of you probably already have a screener. If anyone doesn't have it, I will drop the link in the chat. Now let me open the screener, and I want to show you something. Well, let's take here, for example. Oh, what a wonderful trend. Let's take like this part of the chart. Look what's happening here. First, we had a long accumulation phase right here. Then what happened? The participation phase started here. Then again, it was freeing the margin, then again pushing the asset, then again freeing, then again push, and again freeing. You see how much money, can you imagine how much money he has to have in order to push the price? Let's see how much. 150%. 150%. Just one move. You see what happening? He released some margin slowly, then push again the asset, then again release, then again push, then again release, then again push. So this is like he has to have a lot of money for this. The asset altogether pumped about 150%. So again and again, so he released margin, then again. Why does he release this margin, his margin? In order to gather some resources, and then another push upward, to do another push upward, then again and again. So every push, how much? Let's see, here is 20%, here is 34%, here we have another, let's say 36%, here is another. So these phases, guys, you must learn to see them. It's actually very interesting, and it will really help you in trading. Let's see something else, maybe here also, you see. Let's see, this is long accumulation zone we have. Let's measure it. How much percent he pushed it up? 250%. 250%. Can you imagine how much resources he has to have? He pushed it here, then again, then pushed it here, and now he just exited the position. Okay. Actually, it's very interesting when you will understand, and when you will see and understand these phases, you can absolutely calmly make a decision. You will know how to trade this asset. And of course, it's very actually interesting. It will really help you in trading. That's true. Okay, let's go back here on our chart, and I hope everything is clear about these phases. Okay, let's cancel everything, clean the chart. Okay, let's stay here like this. To be honest, we already touched this topic. I want to look at the next concept. We touched this topic earlier, last lesson, but let's review it again. We talked about levels based on impulse candle wicks, right? And we also talked about breaks of structure. I hope everybody remember that. For impulse candle wicks, we place a level simple as that. We can see it here, you see? We just put the level up here and make it red. And breaks of structure must be at least 5%. So let's measure. I can see this break of structure. I want to measure it. It's 18%, almost 19, so it's good for me. So I can mark it as well here. I hope everything is clear about breaks of structure and impulse candles. Does anyone still have questions? Just write it down. We will go through them, okay? Today we will review these formations once again, but we always mark, like as I said, we always mark upper break of structure and lower break of structure. Let's put it here. And it is in green. Okay, so what else we have? We have let's see, we have here, right? Yeah, the wick of the impulse candle has strong volume. We can see it here behind it. Just look at the volume below, it's huge. The same thing happens, okay, the same thing it happens in here. We can see it here also. You see this one, we have also a big volume. Let's put here also the level, but in red. On the top we place a red level, as I said, that's resistance. On the bottom we place a green level, that's support. For now we don't extend the lower level further, okay? So we just leave it like this. Green support, red resistance. Just remember this. Okay, why did we study break of structure and impulse candle wicks? Because these are formations, but they are not the strongest one. There are much stronger. That's why we always need to check whether the level had a reaction in the past. To do that, we simply extend the level to the left. Let's try this one. Hop, you see? We used the 1 hour time frame, don't forget about that, because the chart analysis is based on the hourly. These levels are somewhat weak, so we check the historical confirmation, okay? And what you can see, here we also have, let's move it more further left like this. Great. And you can see there is one reaction, second, third, 4, 5, you see, and here as well we have many reactions to this level. We have confirmation of the level. This is why break of structure and impulse candle wicks often create a level that we really like. And how do we call it? We call it multiple touch level. And these are the levels we most often trade from. Why is it called multiple touch? I think it's clear, right? Because the price approaches the same level many times. Okay, so here, look, another touch, here. Here we have a little bit undershoot. Let's measure it. 1.49. Okay, here what we have, 1.26. Well, actually undershoot, which is 1.9%, it's a bit too far, but if the price undershoot the level by about 1%, we can still consider it a valid approach. Okay, so when we study risk management, we will go through these details more carefully. Okay, what we can see, look here, from December 5th to December 17th, the asset is not allowed to go below this level. That means a large participant is holding the price. And what formed here from the breaks of structure? Impulse candle wicks and consolidation. What we have here. Let me explain. What is consolidation? When the price keeps hitting the same level repeatedly, we have consolidation here as well. You see? Let me mark it. Here we have also consolidation. What is consolidation? The price keeps hitting the same level repeatedly, and this is called consolidation. The price keeps testing the level. This is what we call trading activity around the level, or simply consolidation. And this actually strengthens the level even more. But again, everything always depends on additional factors and confirmations. For you, right now, the most important thing is to understand the multiple touch concept. Believe me, this is one of the strongest formations in trading. Right now, I'm not even talking about mirror levels. We usually don't trade them directly, but we just keep them in mind. Okay, now another important point. When you build multiple touch levels, you will have limits for candle wicks. You see here, there is a candle wick. You will see it in your homework. You can use actually candle tool here to mark them. For example, let's see where we have it, like this. We have it here, right? For example, we can mark the bottom touches in green, right? Let's put here like this. We have here also we have touch. Here, let's say also, because it's 1% undershoot, it's okay for us. So we have also here, and we have here. So like this, I'll put it like this, okay? So and of course, on the top, at the top, we mark the touches in red, right? So these are multiple touch areas, and therefore this is a potential trading zone. This is exactly where we will be looking for entries, where the price approaches the same level multiple times. Okay, so I place some marks here on purpose because we'll return to this area a little bit later, okay? Here on the top, you can place a red arrow because we have a clear touch as well here. Okay, we also have a wick from impulse candle, as I said here. You remember we put a level like this. Okay, so what we can do, we can build a level just dragging the level like this, the ray, into the historical chart. And now the key thing is to balance the levels so that we get more touches. Why do we need to balance the level? Because a level is not a point, it is a zone. I want also to put like this, like here. And we have a zone, you see? It is an area where the price operates. So remember this very clearly. A level is always a zone. Okay. Now you will have some restrictions. Maximum wick overshoots no more than 1.6%. Okay. We will return to this when we will talk about strategies. So we mark the level based on the impulse candle wick, and we extended it to the left, right? So try to make sure that your level has as many touches as possible, like this, you see? Let's put a little bit down like this. Okay. If you place the level like, let me show you, for example, if you place the level like this, on this candle, on this wick, so what we have, what happens? You end up with only one or two touches, or two, you see? That means that fewer trading opportunities. So we always have to balance the level. Let's put it back here and here, like this, okay? We balance the level in order to get more touches. But remember, again, I'm telling you again, it is a zone. It's not a single price point. Okay, so another important rule at the beginning, especially for beginners, the wick limit is 1.6% maximum. 1.6%. Please remember this. This is important. How do we measure it? You already know. We take the ruler and just let's measure this one. You see this wick. It's 1.34. That's okay for us. We have also over here wick of candle. Let's measure it. It's 1%. That's okay also. It's perfect. It fits perfectly within our 1.6% range. Okay. One more thing which I want to tell you, when you build levels, please pay attention to round numbers. For example, here we have 0.4. You see 0.4. See it here. If you draw a level at 4,000, let's say 4,000, you can see how the price reacts around it. So this level is exactly at round number. And very often strong levels and multiple touch areas are close to round numbers. Breakouts also, spikes, impulse candles weak, they often appear around round price levels. Okay, but remember one more important rule: we do not trade round numbers directly. We do not. We only use them as an additional reference point. The key idea you must remember is this: the price approaches the same area multiple times. Okay, that's the main concept. Let's mark another example. In your homework, you can do the same. Mark the multiple touch area and place arrows where the touches happen, like we did over here. So let's do it the same way, only on top. Just down arrow. Okay, so let's put it, we have it here. We have it here also. We have it here. And we also have it here. Okay. We have multiple touches below as a support and as a resistance on the top, above. Okay. So what we have, what we can see here, it is a trading zone. You see, look at the size of this range. What we can see here, we have a support level here, we have a resistance level here, and we have this area, right? So we have it, this one. This is an area. It is a trading zone. Let's see how much does it. It is a level 11%. So that's good. It's working for a working area. That's great. And exactly what we are teaching now in phase trading. We use precisely this accumulation and execution zones. So you have about 11% range to work with. And well, trust me, that's a very good range for trading. And one more detail. Let's go back to this consolidation. It is small. It's not, it looks like it's small consolidation, right? You have to pay attention to this kind of places. When candles move along the level for several hours, as I said before, this is called consolidation. The consolidation range actually can be 2, 3, or 5%. Let's see how much is this here. It's almost 4%. 4%. That's good area also. Actually, we also call this formation like the fence. And as scalpers, we can actually trade inside of this consolidation. But for that, you need a bit more experience and knowledge. Right now, I'm giving you as many reference points as possible. We strive to provide you with as many reference points as possible, such as Bitcoin correlation and some others. And all of this part of your trading skill development, actually. So always watch the consolidation, okay? And remember that consolidation actually strengthens the level. And every breakout of a level also strengthens the level, okay? Your job is to learn to recognize when a level is truly strong. That's important. Okay. So here we have two key areas, right? As we said, the lower area and the upper area. Inside these zones, a large participant is holding the asset for a certain period of time. And exactly this is your working area. I hope that is clear for everyone. And tell me, please, do you understand now what consolidation around a level is? And what a multiple touch setup is? Just put pluses if you understand everything and everything is clear. Okay. Okay, let's stay here for now and we'll come back to this point a little bit later. If you have any question about multiple touch levels, please ask freely, don't be shy, don't hesitate, okay? Let's go here on the empty chart. Actually, let's do a little break, about 10 minutes break, okay? But I have something interesting for you today. During this break, I want to show you a trade, what it means to scale in and scale out in parts, and why we insist on doing it this way, exactly this way. All our skill strategies are built on this thinking like a major market player. You know, this is how professionals actually work, and this is the level we should aim for. I just put it for this break, and you will watch it while drinking some tea maybe. Okay, guys, we will go on watching next break, okay? So let's go on. Now we have a very important topic to talk about, and now we will talk about risk management. This is very important. Let's write it down. Risk management. And let me put it like this. Okay. For beginners, this will be something new. So, but before we begin, let's cover the most important idea. I'll even highlight it for you, okay? It's important. Let's write like this. What is important? Important. When people come to the market, to the exchange, and start trading or learning to trade, most of them think about profit first. How much will I make? What leverage will I use? How much can I earn? But that's not the first thing you should be thinking about, actually. The first thing you must think about is how to protect my deposit. How do I protect my deposit? This is the first thing, and I want to write it down. That's very important. How do I protect my deposit? This is important. Each of you will receive $21, and believe me, I also started with $21 and then gradually worked my way up. Nobody comes into trading and immediately starts trading 1,000 or 10,000 properly, okay? You have to grow into bigger size step by step. Otherwise, people burn out very quickly, because when you start trading bigger size, everything changes. The entries are different, the exits are different, the psychology is different. So first you need to train your mind. This is important. So as we say, the first rule is to protect the deposit. Please treat these $21 as if they were $21,000. I don't know. Don't focus on the money itself. Just follow the algorithms, follow the rules, and things will start working out. Okay, the second point is reduce risk. This is also important. We have to reduce our risks. That's exactly why risk management exists. Okay, and the third point, a professional trader must be able to catch the big move. Not just small scraps, but riding the full extension. Let's write this down as well. Let's write it like this. Catch a big move. This is one of the foundations of professional trading. Okay, so let's put it up here somewhere. Like this, okay? Okay, a quick word about commission. There is a question about commission. Honestly, when you start trading properly, you stop obsessing over commissions. They exist everywhere. That's normal. Every exchange takes commissions. What really matters is not the dollar amount, right? You remember we were talking about. That's not a dollar amount. We don't look at the dollars. we look at percent. This is more important. Okay, we need to move the we need to look on at percentage move. When you trade in the terminal, you please look at the percentage of movement, not at the money. We don't need money to look on at. This is very important actually habit to build. Okay, now let's go back to risk management. The first concept is we have a risk per day. Let's write that down. Risk per day. Okay, and we have a risk per trade. Let's use a simple example. Let's say the deposit is $100. That will make the maths easier, okay? But before that, one very important distinction. There is deposit and there is position size. Let's write this also down because it is important to understand the difference. Deposit. What is deposit? Deposit is total capital which you have. Okay, what is position size? Position size, it is the amount you actually enter the trade with. Let's write this down. The amount you actually enter the trade like this. So you need to understand the difference between these two things. Let's do this 18 like this. Okay, this is important difference. You have to know that. For example, your deposit is $100, okay, but you enter a trade with $50. So $100, it is a deposit, your total capital, and $50, which is in your position, it is position size. I hope that's clear. Now, in our school, the standard risk per trade is 0.8%. Let's write this down as well. 0.8%. Sometimes people ask me, why not 0.5 or why not 1% or 1.5%? Because 0.8 is psychologically easier to handle than 1%. And 0.5 is often too tight, especially in a volatile market. So, and the asset can stop you out with just a week. Therefore, 1.8% is optimal. Okay. Let's do this like this. Let's put it in green. Okay. Now let's calculate it. We have $100 deposit. Okay, and it equals to 0.8%. What we do, we divide $100 by 100% and multiply by 0.8%. And how much does it gives us? It gives us $0.8 or 80 cents. That is your maximum allowed loss on the trade. On the trade. Okay? And if, to be honest, losing 80 cents out of 100 is completely acceptable. Some people risk 5% per trade, but just think about this. 3 losing trades in a row, and that's already 15% of the deposit gone. Out of $100, that's $15. That's exactly why we stick to 0.8% risk. It's healthy, safe, professional risk level. Okay, don't hesitate to ask questions if you don't understand something, because you're going to trade under strict risk management, and this must be understood once and for all. Okay, now let's talk about a classic beginner mistake. Okay, let's say we have a level here. We have some price going up here, then go down there, then it starts going down. Let's do everything beautiful. Okay, like this. You put your stop loss somewhere here. What do many beginners do? As soon as the price gets closer to the stop, they start moving the stop further away, more down. They hide it behind the level, then even further and further again. But I will tell you, this is unacceptable. This must not be done. Don't touch your stop loss, because this quickly turns into a habit, and one day that habit ends in liquidation. Yeah, just imagine you have, for example, you have $100, let's say $100, and you lost $50 by moving your stop. $50. Now you only have 50 left, right? And what happens psychologically? A person starts thinking, oh, no, I have to take back what market took from me. And then boom, only $20. Again, loss. It's only $20 left. Okay, now I'll make it back right away. I want to take it back from the market, but it's not happening. When suddenly you are down to $20 and now you are desperate to recover, but the missing 80 is still gone already. You don't have 80 bucks. $80 are gone when you start moving your stop loss. And this is exactly how burnout begins. So remember this rule. We move the stop only into profit. Only. Not away from it. We don't move it away from ourselves. We move it forward in the direction of protection and profit. This is something you must train. To click the buttons and move the stop up, but never ever move it down to increase your loss. That's a major mistake, guys. Do not do that. I hope everything is clear, right? Okay, if everything is clear about risk per day, then you are already much closer to being ready to trade, because this is something you absolutely must be prepared for. Now let's move on to the next point. It's a risk per day, daily risk. I think you all know the classic rule, right? So the 1-to-3 ratio, we were talking about it last lesson. So look guys, here is rule number 1. 3 losing trades, stop trading. This is important as well. I want to write it down here. 3 losing trades in a row. Let's do this like this. Stop trading. Stop trading. Let's move it a little bit like this. So 3 losing trades in a row, stop trading. We don't trade anymore. We close the computer and go for a walk, for example. Okay, remember this. It's also an important rule. Even if you stopped a bit earlier, clicked something, didn't reach the full daily loss limit, still stop the trading. You will see this in your trader diary. If you have 3 consecutive losing trades, it means something is off. Maybe the weather is bad, maybe your mood is off, maybe you are feeling bad, maybe, I don't know, maybe the market just isn't working for you today. Just stop and rest. Okay, this rule actually is strict, guys. Please stick to it. It will make things much easier for you and you will avoid getting blocked. Okay, now let's talk about what a block is and when it happens. Look, if our risk per trade is 0.8%, then what we do, 0.8%, this is our risk per trade. As I said before, we have 3 losing trades. We multiply by 3 losing trades. How much does it? It is 2.4%. This is block. Let me write it like this. Block for 1 day. I will send all of the pictures in the chat, so don't worry about that. Yeah. So your daily risk limit is 2.4%, and if you hit that limit, you may get blocked from the trading. Don't be scared, guys. If it is your first time trading, it's absolutely possible to hit 3 losses. And yes, trading may get blocked. But don't worry, only for 1 day, till next day, okay? So if you're trading capital, for example, $100, then 2.4%, this is $2.4 per day. That's basically how much you can lose, right, in 1 day, not more. And now think about it. How many days in a row can a person keep burning out like that before blowing the deposit? That's exactly why we teach you not to rush and not to follow the rules. Okay, so we are still going to go through all of that in detail, colleagues, please. So don't worry about it if you don't understand anything right now. Right now, I want you to drop some pluses in the chat so I know that everything is clear right now here about risk per day, about risk per trade. Okay, that's good. Now, Now that we understand risk management, let's go back to our chart. Let me, where we were, here. Okay. Okay. So, why was I talking about wicks and about 0.8%? Because with 0.8% wick size, these formations are harder to find right now. But with 1.6%, it comes much easier. So here we found a multiple touch setups, as we did it before, right? So the level of resistance and level of support. At this point, we don't know which side is stronger. We have no idea. And we also don't know exactly where the asset will go, right? So, for example, here it can go up and it can go down. We don't know. In these consolidations, there are two options, right? Either up, either down, or down. And yes, of course, you can also look at additional clues, such as Bitcoin correlation and so on. That's great. But what we are giving you right now is multiple touch plus consolidation. That's your base. And now let's look at a technique called stop manipulation. Let me write this down as well. Somewhere here, up here. Like this, okay? Let's write it down. Stop manipulation. Again, with 0.8% wicks, you won't find that many setups, but 1.6% already shows up much more often. And our task is to hide the stop behind the level and behind the wick. And for that, we need a wick that is no larger than 1.6%. Let's see. This one, for example. 1.4, let's say. Okay, that's good. Almost, but it's okay for us. We can hide our stop loss at 1.6. That means it works. Okay, let's see this week. 1%, 1.1. That's great. And this is exactly where stop manipulation helps us. It expands our options, okay? Look, now I want to show you how it works. Let's say your position size is $100. We already stick to $100, right? $100. If you don't enter with the full $100, but instead enter with $50, what we have? Let's start not from 100. 100 we already written down. So let's say $50. What we do, $50 we have to multiply by 100%, right? And multiply, we have to divide on 100% and multiply by 1.6, as we said here, right? 1.6%. This is our stop loss. And how much do we have? We still have 0.8%. Dollars, sorry. $0.8, right? So your dollar risk stays the same, you see? But your stop can now be wider because your position size is smaller. Do you see the logic in it? So if we have $100 in our position, we can put our stop loss 0.8 because this is the risk per trade. But if we decrease our position size to $50, so we can increase our stop loss. And it's still, in the end, we will have $0.8. Do you see the logic? I think, yeah. Now here is the question. If you enter with $10, how wide can your stop be? Okay. It can be 10 times wider than it would be at full size, right? So that's logically. Actually, the logic is simple. The wider the stop, the smaller the position size. The smaller the position size, the wider the stop you can afford, while your risk in dollars stays the same. Okay, so I want to write you down like a table, to do for you like a table in order to you to have it. So let's do like this. $100, we have $100. Our stop loss will be 0.8%, right? If we have $50, our stop loss will be 1.6%. If we have $40 as a trading size, how much do we have? How much can we put the stop? Please write it. I'm waiting. Just guess. Try to answer. Of course, 2%. 2%. Okay, let's go on. $30. How much stop can we put? 2.7. Absolutely right. Okay, let's go on. $20. 4%. Absolutely. $10. 8%, right? And let's count the 5. If you want to get into the position, $5. How wide stop loss can we put? It's 16%. Can you imagine 16% stop loss? I want you to have this. Let's do it like this. Okay, and one more thing I want to here, like a rule to write you down. Let's write it like this. Double the stop half the trading size. I think everybody will understand what it does it mean. Like this. Let's put it like this. Okay. Let's make it in green. Okay. So we have this table. You have already trading size and stop loss, which you can put with this trading size. And what we have, as we said, whenever, doesn't matter what trading size, what stop loss you put, In the end, if it will hit your stop loss, you will still have $0.8 loss. Okay, so this is important. This is very important. Just remember this and try to stick to it. Don't move your stop loss. If you want to put a wide stop loss, just decrease your trading size. Okay, so I want to show you one more. Let's write down this one more example. Here we have $50. Let's say we want to enter with $10. $10. What do we do? $10 we have to divide by 100% and multiple by 1.6%. That's stop loss. And how much do we have here? Who will tell me? $0.8, of course. Still 0.8, 80 cents. You see? So like this, by this formula, you can count your trading size and your stop loss. Okay, this formula, actually, it's very important formula, and I want you, as I said, I want you to stick to it very strictly, actually, because it is important, as I said. Okay, you may actually this what we wrote here, what we have written here. Exactly we called stop manipulation. You may ask, but if the position size is smaller, won't we make less money? Yes, the position size is smaller, but right now the point is different. What we are teaching you is this: you enter with small size, with small lots in parts, and you also exit in parts. And that is completely normal, because the beginner's job is to build experience and screen time. And believe me, if you enter with just $10 and catch a 5 to 10% move, that's already very good. The key thing is that you did it according to the system. Okay, so that's important. And that's something you really need to keep in your mind. Okay, now please tell me, is this part clear? And is the whole risk management block clear for everyone? Risk per day, risk per trade. Okay. Okay, that's good. Let's go on. Let's again clean the chart. We have many drawings today. Now one more thing, especially for complete beginners. A lot of people get confused about how to place levels and trend lines. And let's review it quickly. Let's say we have, okay, let's say like this. Like this, for example. We have upper level resistance in red, right? We have lower level support. It is green. Okay. Let's say we put, and how do we place it? We place it with a horizontal ray. This is also important, horizontal ray. Now, let's talk about trends. An uptrend is drawn from bottom to top, like this, and it is in green. Okay, it goes from down to up to upward. Okay, and a downtrend is in red, and it goes from top to bottom. I know this sounds very simple, but a lot of people actually make mistakes here. And look, here the asset, for example, moves like this, down along the trend. It goes down like this. Then what happens? Then it starts going up here. Okay. And what happens next? Let's see. For example, let's do like this a little bit. And the more times the asset approaches a level, the stronger that level becomes. You already know about this, that? So we go up here, it approaches up level, then it goes down, then again goes up, so that looks strong. Then again it goes down, then up, then down, so this is strong level. You have touch here, you have touch here, here, and down here. So this is strong levels. And one more point for the beginner, long and short. I don't know why, guys, you mixed it up. We run into this confusion all the time. Seriously, let me show this for the beginners because it's important. It's important actually. Let's do like this. Well, okay, let me draw it here separately. So we have trend up, let's do like this, it's green, and we have movement down. Okay, like this. So what is short and long? When the price is going up, it is a long position. Let me even write it down. It's long. Long is buy. Like this. And when the price goes down, that's short. It's sell. It's always sell. Over here is an entry point for short. It goes down. And here is the entry point for long. It goes upwards. I think till here is everything clear, okay? So long, it is a buy position. Short, it is a sell position. Okay. Long, what does it mean long? You buy cheaper and you sell higher, right? So, for example, let's say you bought, well, let's say it here. Let's do it like this. For example, you bought at, and here you see the price 0.6, 6,000, let's say. So you bought it here, you sell it here. So you bought cheaper, you sell it expensive, you sell higher. What happens in short position? It's a little bit confusing, but don't think about it. Just remember one thing. You sell here, let's put it in red, and you buy here. So you sell higher and you buy cheaper. Okay, so with the short position, a little bit confused, but as I said, don't think about it. Just remember about this structure. For short position, you sell higher and you buy cheaper, and then that's how you earn your money here. In long position, you buy cheaper, you sell higher. That's all. That's all you need to know. Okay? Just don't overthink the names or something like that. Just remember the logic. Long is up, short is down. That's all. Okay? Now one more thing. These are the places where you will set your take profit. Let's repeat it once again. You bought your you bought a long here, for example, yeah, and you sold it here. You start going up. You're going up. So you bought it here and you sell it here. For example, yeah, let's mark it in another like this. So that is also your take profit. You see, you will put your take profit right here. And your stop loss down here. I think this is clear. That's easy. Okay, what about short position? When it goes down, you put your take profit as we said here, you remember, you take your take profit right here. So this will be your take profit for short position. You will sell here, you will buy here. Okay, so profit is simply the price difference. I think everybody understands that. I think it's clear. Okay, so let me ask one more time. Is it clear what long is, what short is, and what long and short positions means? Yes, I know we are spending time on this, but since this is the base, guys, and there are many beginners are here, then it has to be the base, you see? Many people don't understand even what is long and short position. That's why I'm trying to explain more carefully, more, and talk about it more, you see? Okay, let's go on. Now let's talk about strategies. Let's go back to our chart over here. Okay. Now let's write down it here. I mean the exact strategies you will be using once you start trading, okay? And yes, there will be homework as well on this everything, okay? Actually, I want to say that traders usually fall into two camps. First, it is a bounce strategies, traders who trade bounce strategies, and traders who trade breakout strategies. So basically, you either trade a bounce off a level or a breakout through a level. There are fewer breakout traders actually. That's already a more advanced story. Breakouts are not for everyone and they don't happen as often as bounces. So at the first stage, guys, we trade the bounce strategy. Breakout strategies will come later, step by step, okay? So we trade the bounce from a multiple touch level. Let me write this down. Bounce strategy. Bounce strategy. Okay, now let's go over the limits for beginners. First, volatility at the first stage, let's keep it roughly around 1.7 to 2%. No need to take more than that for now, okay? So don't take more than 1.7 to 2% volatility. Second is candle wicks, as we say, you remember here, as agreed, the wicks should be no more than 1.6%. And so for now, we calculate our stop loss based on 1.6%, okay? Okay, now one more important point, the stop to take ratio. Actually, a few years ago, maybe 5 years back, it was pretty normal to target 1 to 3 ratio, but the market is more difficult now. So at the first stage, let's stick to 1 to 2 ratio. That means if your stop loss is 1.6%, then your take profit should be 3.2%, right? Now let me tell you what important for me to see in your homework. I want to see that you correctly found the multiple touch level, correctly build the level itself. Understand whether your entry is supposed to be long or short, right? So as we agreed, green arrows mean long, red means short. That part is clear. Okay, we are not coming back here. A multiple a multiple touch setup is one of the strongest formation, as I said before. And in the advanced training, we give a lot more detail on how to trade it. But those are huge lessons actually for 5-6 hours. But right now you need to core foundation that you can already work with. And believe me, if you trade this strategy according to the algorithm, you will see that it works actually. Okay, now let's move on to the entry algorithms. Let's write it down. Algorithms. The main thing is to find a strong level. This is a very important. Don't rush. Nobody's pushing you anywhere. Find the multiple touch level, identify the approaches to the level, study it, analyze it, and then calmly enter according to the algorithm. Okay, so today we will have two types of algorithms. So the first one, which I want to talk about, is position building inside the 0.4% zone. 0.4%. before it used to be 0.3%, but now we make it 0.4 because the market is much aggressive. So the idea is this: we build a position inside a 0.4% zone from the level. Okay, let me explain it visually. Okay, let's draw it here, for example. Okay, for example, we have a level. It's a multiple touch level. It's a strong level. Let's draw it like this. For example, here there was a wick of candle. Then there was some consolidation here, for example. Then it goes up, then again down. So like this. And it went up. Okay, so we have some wicks here, right? The price have moved around, approached everywhere, here, so it's a strong. Okay, we assume that there will be a bounce into a long, for example, here. Okay, it doesn't really matter whether it's long or short. So the logic is the same, but let's use a long example. It's much easier. And one more thing I want to add here: sometimes there is a break of structure and then confirmation follows. The asset comes back, wicks the level with a thin candle, and wick stays on the level. Here, for example, on the level, the wick stays on the level, but the body of the candle closes above it here. Those little needle touches are also a confirmation that the level is alive. You have to notice it. There is such a thing as the strength of levels. Okay, so for example, there is a break of structure only. For example, let me draw it one more. For example, we have a break of structure only. This will be number 1. And there is let's say, something like this kind of structure. Goes up, down, then there will be wick of candle wick, then it will be consolidation, then it again impulse up. This will be number 2. What do you think? Which one is stronger? So here we have just break of structure. Here we have break of structure plus wick through the level plus impulse candle tail. So which one is stronger? Yes, of course, it is the second one. It is the second one. Because if you see a break of structure, then a wick through the level, then a return, then the asset trades around there for a bit, then moves again, that's already tells you that the level has strengths, right? I'm giving this to you briefly, piece by piece, so you understand what's actually happening, So in the end, everything depends on the strength of level. Now let's talk about entry zone. If you want to enter a long, then obviously your entry zone will be above the level. So if this level is support and you want to enter long from this level, then the zone will be above the level. Okay, let's mark it. Above the level here. 0.4, as we agreed with you, 0.4%. Let's put it like this. 0.4% above the level. Okay, if you are going long. Let me repeat one more time, guys. A level is an area. Even if a wick sticks out and pokes through the level, we still understand that all of this creates a zone. Yeah, so we can put here, for example, like this. So this is a zone. And we must take into account this. And that's exactly why we hide our stop loss behind that area, behind the wicks. Here, we protect our stop loss. Now, how do we actually build the position? We will build a position within this 0.4% area. And even in this kind of formation, guys, in this kind of multiple touch setup, you can calmly take 3.3 to 2.35%, okay, profit. Let's see here again. Let's come back here. Look, there was a level. Here was the entry, for example. Here we entered our trade, and then the price moved up. Let's see how much. It's 4%. If, for example, we entered here, even till here, till the first, it is 6-7% almost. Here it is 10%. Here it is already 24%. So on average, you can calmly take 3 to 5% profit without rushing, in a quiet and controlled way. I think this is clear, right? Okay. So now let's go to advantages and disadvantages of building a position inside of this 0.4% zone. And yes, there are both advantages and disadvantages. Okay, let's write this down. Advantages. First, actually you clearly understand. Yeah, so here is the level, here is the zone, and that's where you work. So how can we call this advantage? Let's write it down like this: very clear position building around a key area. Let's write it like this. Very clear position, let's like this, position building around a key area, like this. Second, the stop stays relatively small, and you can easily place it behind the wicks and behind the zones, because this zone is very close to your level. Okay, so let's write it down like this. Easy to hide the stop behind the strong level. Easy to hide the stop loss behind a strong level. Okay, what else do we have? The asset is not flying around widely, right? That's why I told you at the first stage, keep volatility around 1.7 to 2%, so everything stays calmer. So how can we write this point, this advantage? easy to build big size position. Big size position. While the asset is trading inside the consolidation, while it's moving around quietly, you can calmly build your position here, right? So, and this is important. Right now, you're trading $21. But imagine that it is $21,000. The strategy actually works the same way. It doesn't matter. The only thing that changes is psychology. If you work through this properly now, you will really enjoy it and you will see progress. You will realize that you don't need to jump from asset to asset trying to catch crazy pumps, right? So just remember this. Okay, another thing, it is a very good option for beginners, this zone 0.4. I want to write this down as well. A very good option for beginners. For beginners. So let's make it like this. So these are advantages. Let's put it like this. Do it beautiful. And let's mark this also like this for you to remember it. Okay, so let's go on. And of course, we have disadvantages. Disadvantages. But there is only one. Sometimes the asset may simply not reach the level. It can happen. Yeah, that's true. So missed entries will happen. So you will be waiting for it, but it will just reverse and go another way. So that's exactly why we use the stop manipulation technique. But still, the fact remains, sometimes the price touches the area and leaves impulsively. Oh, that's okay. Don't get upset. Just move on. Look for the next asset. It means that's not yours. Wait for the next approach and don't rush. Okay, so let's write this down like this. Missed entries. Let's do this like this. Missed entries can happen. Okay, let's do it again. Missed entries can happen, and I won't write this like this here, that sometimes the price doesn't reach the level. Let's write it like this. Sometimes the price doesn't reach the level. Okay. So like this, we have advantages and we have disadvantages. Okay, now a question for everyone: on which time frame do we analyze the asset, and on which time frame do we make the entry decision? Write it down, please. I'm waiting. Yes, of course, correct. On the 1 hour chart, only on 1 hour chart. As scalpers, we use 1 hour as our base, and sometimes we additionally look at 15 minutes, especially when drawing trend lines. Okay. Okay, so now let's go on. Now look here. Let's get back again here on our chart. Let's go like this, a little bit wider in order for you to see it. Let's see. Okay, if we put this level a little bit down, you see, like this, what we can see? We can see consolidation. You see, there is a consolidation here. What does it mean? It means that the asset approached the level, got stuck there, and started moving along the level. That's your consolidation, actually. And this consolidation itself can be, for example, 2%. I think it's about 2%. Let's measure it. Yeah, it's about 2%, you see? 2%. From top to bottom, from the red resistance level down to the green support level, we can measure it, and it's 2%. Okay, now let's go through the bond strategy workflow. First, as we said, we analyze the chart on 1 hour time frame. We find multiple touch level. We see consolidation. We make a decision, long or short, right? We calculate the stop. As for the wicks, we already agreed for now the stop can be up to 1.6%. So if the stop is 1.6%, then with a 1 to 2 ratio, the take profit will be 3.2%. Okay, so now an important point about position size. If your deposit is $21, let's write this down also as well. Let's call this down. $21 deposit. So if your deposit is $21, then 100% of your deposit equals $21, right? Okay, but if we are working with a 1.6% stop loss instead of 0.8, as you remember, if it is full deposit, $21, maximum stop loss can be 0.8%. If you want to put 1.6% stop loss instead of 0.8%, then we enter with roughly 50% of the deposit, right? So roughly speaking, it's about $10, right? That makes sense, right? Okay. And one more important point about the exchanges, you have 2 exchanges. I forgot to tell you about this. It's Bybit and Binance. On Binance, the minimum lot is around $6. On Bybit, the minimum lot may be smaller, around $2. So on Bybit, you can split your $10 into five parts of $2 each. On Binance, Usually it will be more like 2 entries of around $6 each. Okay. Okay. So I want to write down this also in order for you to have it. Let's write it like this. 1.6%, this is your stop loss. This is your stop loss. It is 50%. 50%, let's say, and 50% of your deposit, right? So, and it is equals to $10 trading size. Do you remember what is trading size? Trading size. This is the amount with which you are going to get into your trade, right? Okay. So this one I also want to leave it here for you. Okay. Okay, now I want to as well, for you not to be confused, to write down this thing. Okay, let's, as we said, about $10. We have 50% of our deposit. It's $10, right? $10. So let me write it like this. On Binance, you have to split. Do you remember? You have to split your trading size. On Binance, you can split it like this. $6, $6 two times, right? Two times. On Bybit, $2. This is a minimal lot size. 5 times. 5 times. Okay, as we agreed with you that we have maximum stop loss of 1.6%, and we hide it behind the strong level or behind the wicks of candles, right? So stop loss adding 1.6%. We agree. So if we have stop loss 1.6%, so it means our take profit will be somewhere here, 1 to 2 ratio. You remember that? So take profit will be 3.2%. I think this is clear, right? Okay. Now look, you have you have analyzed the asset, set your levels on the 1 hour time frame, and defined your stop loss 1.6%. You have splitted your position size into, let's say, 5 parts if it's Bybit. And next, what we do, we switch our time frame chart to the 1 minute time frame chart and load 1 part every minute. I will show you how to do it, okay? Now there is an important, most important question. Why do we enter in parts? Because if you enter with one full order and the asset starts moving toward your stop, then you have already committed the full size. But if you enter in parts, then until the whole position is built, you still have flexibility. And if the stop gets hit, your loss will be smaller because you didn't enter with full size right away. Okay, and if the asset makes a little poke then comes back, you can continue buying inside your zone. It can happen, and it's actually very often happens. So the rule is we add only inside the 0.4% zone. If the price leaves the zone and goes into profit, we do not add more, because otherwise your entry point shifts and you worsen your average price. Okay? If it already moved into profit, that's it, you are in position. Now you wait, and from here the profit-taking algorithms start to take over. The amount loaded into the position doesn't matter, even if it's only $4. You just write that $4. But don't add to the position once the asset leaves the 0.4% zone, okay? And one more thing, you have to remember, I told about this already, but I want to repeat it, that we focus not on dollars. You remember? Not on dollars. We focus on percentage. Okay? If you didn't enter with the full size, that's okay. What matters is that you capture the percentages. You have to write the move according to the strategy. This is trading, okay? All right, guys, let's keep going. There is a question that everyone always asks. If I'm fully loaded, for example, and the asset stays in consolidation for 4 hours or 1 day, can I exit? Of course you can. If you are tired, just get out of the trade. But inside consolidation, there is often still movement. There is a movement plus 0.5% or 1%, so you can take that and exit, and that's all. But if you are working according to the plan, when you already have a stop and take profit and you understand your risk in advance, okay, so I think everything should be clear about the 0.4% entry zone. If you have questions, ask. This is the foundation, and now I want to give you one bonus I have. Okay, we will be expanding the entry zone. Let's go back here. Like this. Now we'll talk about zone, which is 0.6%. That's interesting. The idea is this. Let's draw it again. Well, let's draw like this. Here's the level. It's strong level. Yeah. So there is multiple touches, consolidations. Here, for example, goes up there, then there is a wick throws. Everything is there, everything we have. Then it went up there, and then it starts to returning back here. Okay, so we have a strong level. We have a wick. We put here also level, because we know that this is the zone. It's not a level, it's a zone. So we place our stop loss behind this wick, 1.6%. Let's say it is 1.6. Stop loss 1.6%. But now, instead of building the entry manually, candle by candle on the 1 minute chart, you remember? You build it using limit orders. Let's say here is your zone. Let's mark it like this, for example. Well, let's do like this. Okay, for example, let's say we have $20. We have $20, okay? You split them into 4 limit orders of $5 each and place them evenly inside the 0.6% zone. This is our entry algorithm 0.6 zone. Okay, so let's do it beautiful. $5. Okay, we put here, we split this zone equally, evenly, okay, like this. This is your $20. Your first limit order, then second, third, and fourth. We have $20 split it into 4 parts. Okay, if the asset takes all of them, then your average entry price shifts somewhere closer to the 0.4% area. Somewhere here it will be. Which means you end up close to the zone where you originally wanted to be anyway, right? So I want to write this down also in order for you to remember this. It's also important. Let's write like this. It will be entry point. Entry point. It's like this. So it will be approximately 0.3%. It will move down. So this will be your entry point. You will start gathering your limit orders from here, then third one and fourth one. So, and your entry point will be approximately 0.3%. Okay, I think this is clear. That's okay. Let's now go through the advantages of these setups, because there are advantages and as well as disadvantages. Not a lot, but still they are. So let's write this down. Advantages. First, what is advantage of this kind of algorithm? It is higher probability of getting filled, right? So why? Because the zone is wider, so the asset is more likely to touch your limit orders. Let's write like this: higher entry probability. Okay. Now, what else do we have? So second advantage, it's simplest possible way. Why do I call it simple? Because you don't have to sit there watching every minute and calculating. Did the price leave the zone or not? Should I add more? Should I press button again? And so on. And you just set your limit orders and that's it. The position structure is ready. You calculated everything, placed the orders and moved on. You don't need to sit there clicking every minute, you know. So let's write down the second simple position building. And yes, with limit orders, commissions are often lower too. But right now, that's not the main point, okay? The main point is that you understand the mechanics and the risk. Okay, what are the disadvantages of the 0.6% entry with limit orders? Let's write them down also. Disadvantages. The first disadvantage, it is you have less control. Okay, so you place the whole grid and the asset may quickly collect the entire set. This is first minus of this entry zone. let's write it down. Less control. What else do we have here? The second point is there is a higher chance of taking the full loss. What does it mean? If the asset fills all of your limit orders, all $10 or $20, and then goes to the 1.6% stop, then the loss will be based on the full loaded amount. Okay, so whereas with the manual entry on the 1 minute chart, it might happen that you only manage to load $4 or $6, not the full trading size. In that case, if the stop gets hit, the loss is smaller. Okay, I think it's clear what full loss means here, right? So let's write this down. Higher chance, let's write it like this. Higher chance of taking the full loss. These are advantages and disadvantages. The most important thing you must remember, if the asset fills your full grid of limit orders, then your average entry price will end up very close to the level. So here, approximately 0.3% or 4 maybe. So it is around, roughly around our previous zone 0.4. And at the same time, you still remain within risk management. That is the key point. Okay. About the stop in the trading terminal, it's important. The stop can be configured in advance. It should be, not should even, it must be configured in advance. And then it will be placed automatically. The logic is, as soon as the first limit order gets filled, the stop loss is automatically placed, for example, 1.6%. And from that moment, it already stands there protecting the position. So the stop is not somewhere later. It should be placed immediately before you enter the trade. And it is placed immediately after the first your fill. Okay, so okay, now let's take a break, 10 minutes, and then we'll continue already in terminal, and we'll see how it works. And let me continue our trade, which I put it for you in previous break. Okay guys, let's continue. We have a lot of work to do today. Right now I want to show you, I want to go to terminal and show you how to do this inside the terminal. Okay, so let's open, for example, ADA. We will go step by step, okay, especially for the beginners. First of all, what I want to say that all analysis, as you remember, we do on the 1 hour chart. We build levels, everything we'll do on 1 hour chart, multiple touch setup, consolidation, week throw, everything. The trade decision is made also on 1 hour chart, 1 hour time frame. Okay, and one more important point, please remember that if you see that the hourly candle is still in progress, it's better to wait for the candle close before confirming your entry, especially if it is left 5-10 minutes till changing the hour. Okay, so let's go on. How do we measure the zone with the ruler? Let's first of all, let's see. We put our levels. We have consolidation here, for example. We have break of structure here, this one and this one. So let's imagine, okay, let's just imagine that we have very strong level over here. Okay, how do we measure our zones 0.4 and 0.6? We right click on the chart, take the measure tool, and from this level we measure 0.4 over here. We take another ray, horizontal ray, and put it right like this. So this is our zone 0.4, and the same way we mark 0.6. Okay, so these levels we're drawing with horizontal ray. Okay, so you place the ray and mark the borders of the zone, so you can see this is our zone to enter. After that, what we do, we switch the chart to the 1 minute time frame over here, and we already can see this is our zone. You see, it's much wider on 1 minute. And over here in order book you can also see it's marked like in red. This is our zone. So right now the asset, the price is in our area, and we can get into the trade. So one time in 1 minute you just click in this area, okay, when the price is in this area. If the entry is 0.6, you place a grid of limit orders and don't trade it manually. So in this area, let's see, where is the 0.6? This is our level. We go down and we can see that over here we have 0.6%. So we take array and we put it here. Okay, so this is our area 0.6, and in here we divide it into equal parts. For example, if your stop loss is 0.8, and just put here limit orders, and that's all. That's how we mark our levels. Okay, now let's come back to our chart. Then we will return back to terminal, and I will show you already how to work in it. We will get into the trade. Right now I want to talk about exit algorithms, profit taking, because that's for us important. Let's write this down. Exit algorithms, or it also we can call it like profit taking. Okay. So since we enter in parts, so we have to also exit in parts. We will write down everything, just I want to say it. 0.4% when let's draw it. I want to do it like this. Okay, like this. For example, we have very strong here level. Okay, it was going like this. There was a consolidation. There was a wick of candle. Then again it went up, down, and like this. It's very strong. So, and it came back again here. Here we have our entry zone. Let's mark it. Actually, it doesn't matter. 0.4, 0.6, so it's entry zone. Okay, like this. So we put here our stop loss, for example. Here is a stop loss. Let's say 1.6. If your trade went your way, is going your way, so what's happening? As I said, since we enter in parts, we also exit in parts. How do we exit in parts? When your trade is going up and it reached plus 0.4%, let's do it like this. 0.4%, let's write this down here, plus 0.4%. What you do, you lock in 25% of the position. This is important. Let's write it. Lock in 25% of the position. Okay, when it reaches plus 0.4. Okay, what's happening next? When the price is coming up, it's going up your way. So, and now it is plus 0.8% in profit. Yeah. So what you do in this case, you move your stop loss to break even. You move your stop loss, let me write stop loss, to break even, or let's say entry point, a little bit higher. Okay, everything is going good. So, and your price reaches plus 1%. You already see plus 1% in terminal. What you do? you lock another 25%. Lock in 25%. Okay, that sounds good. Let's go more up. The price is moving up. It's very good. You have already 1.2%. What's happening here? What we are doing here, when it reaches plus 1.2%, we move our stop loss into profit to plus 0.6%. Okay, let's write like this. Move the stop loss into profit to 0.6%. Okay, and it's already up there at 1.6%. Actually, for the base level, you can close the whole position, or if you put your take profit in settings, so it will hit your take profit up here at 1.6%. Okay, let's write it like this. For the base level, you can close the whole position. Okay, like this. So that's what's happening. Let's put it like this. Here is a take profit. For example, you put a take profit up here. Okay, so that's odd. For people who already have some experience in trading, actually over here you can just leave a small runner according to the plan. Okay, so and you can trail the stop. But for the beginners who are not yet comfortable with stops and trailing, you can simply set right away. Okay, in settings, stop 1.6%, take 1.6%, or 3.2% if you want the 1 to 2 ratio setup, and just practice discipline. So this is how you exit in parts. It's important, and this is discipline. You have to practice it. So right now I want to write down one more important thing which I want you to have. It is action order. Okay, so it's like a small like a ticks, like a checklist. Okay, let's write down like this: action order, checklist. First, analyze the levels on 1 hour. It's important. Analyze on 1 hour time frame. Second, draw the levels, then check the wick throughs and calculate the stop. Okay. And calculate stop loss. What else we have? What you have to do after that? Then you choose the entry algorithms. Choose the entry. What are they? What we were talking about today? It is, the first one is 0.4%, and it's manually. And we also have 0.6% with limit orders. With limit orders. And the last point is I want you to remember is you have to set the stop and take profit in the settings and remember let me write it in capital letters, the stop matters more. Okay, so this is like a checklist. When you want to enter the trade, first read it, see what you have done, what you haven't done, what you've forgotten, and after that already get into the trade. Okay. Okay, now I want to show you, do you remember we were talking about limits for the first trades? It's very important, the volatility, where you can see it. Let's go back to our screener and what we can see here. As you remember, we talked about volatility up to roughly 1.7 on 5 minutes. This column, can you see it here? 5 minutes 14. So this column you should look for not more than 1.7%. Liquidity in the screener you should set up over here. You see there is a like an arrow. You can go more and more up and down, at least 50 millions. For now, stay away from extremely volatile pump type setups with huge wicks, okay? So don't choose it because they're dangerous actually. You don't know yet how to deal with them. You have to trade, practice, and everything will be fine. And remember, you have one shared account with $21, and that account will work on 2 exchanges, okay? 2 exchanges. And so these are 2 main things which you have to look on the screener. Okay, 50 million volume and volatility on 5 minutes, not more than 1.7%. And you see over here you can look for it. Okay, now let's go back to our chart And I want to write down this for you as well. Limits for the first trades. It's very important. First, volatility. Volatility in the screener. Not more, let's write like this, not more than 1.7 to 2%. Percent on 5-minute time frame. Okay. And the second point, liquidity in the screener. At least 50 million. Okay, so these two things you have to remember, and you have to put it in your screener. So okay, I think we are done here. Let's go to terminal and let's try. Let's see what we can do here. Okay, so now let's look at how the entry mechanics work, okay, step by step. Let's say you decided to take a trade. You choose a level. Let's say here is the level. You mark it. It's appeared in terminal, in order book. We mark 0. Here is the 0.4% area. Okay, let's check it. Or 0.6. We put it here 0.6. Let's put first 0.4. So here is our area zone, 0.4. We can see it here. You see right now the price is out of our zone, so we don't do anything. We don't do nothing. So when the price comes out of the zone, we don't do anything. We wait. We wait when it will come back to this area. Same logic, both direction actually. If you want to go long, for example, from this level, the same way you measure it from here, going up, and put one more array right here. So this our zone to go up. Here we will go up, and here we will go down. So this is for short, this is for long, these two areas. Okay, so as I say, if you are going down, you measure downward. If you're going up, you measure upward. All levels you mark only on 1 hour chart. Okay, once the zone is marked, you make the decision to enter. On Binance, as I said before, the minimum lot is $6. So here I set $6. All setups of the terminal, how to set up it, I will send a video separately in the chat, so don't worry, you will have it. Okay, so here is $6 lot. It is Binance, and you don't have to go big right away. Okay, so just start from minimum. You set the lot size. Okay, now you can work with it. Then we switch on 1 minute time frame and we wait. If the price will come into this in our zone here, we will start to build the position. How do we do that? The left button is for buying, just remember this, or entering a long position. The right button is for selling or entering a short position. Right here I want to go short because I know that here is the level, so I will go short. If it will get into this area, of course. Okay, so before entering the trade, very important, you set up your stop loss. Stop loss, here is the setting of the asset. You go to trading, and over here there is a stop loss and take profit. So I put here 1.6%, for example, or 0.8. Okay, so you decide, depends on the situation. You put it here, you press apply, and that's all. Your stop loss and take profit is set. Okay, I want to show you, but it's not getting into this zone. Okay, let's do another way. Let's say that there is a zone we found. Just imagine that this is our zone, 0.3%. Okay, so we are right now in our zone. If I want to go long, I will click with my left mouse click in the red area. Just remember this. To go by market. So I will get into the by market, into the trade. Look, right now I want to enter long. I press left mouse button in red area. So I just press once. Hop, you see I am in position right now. Now we are waiting for 1 minute. We don't do anything. We will see if the price will stay in this area. So I will press one more time in red area. Okay, we will just wait. Okay, we just wait. We don't do anything. And as you can see, my take profit and stop loss, it was set up automatically. You see 0.6. You can see here there is a ruler at the side. You see 1.6, and my take profit as well on 1.6. Okay, okay, 1 minute is gone, so the price is inside of my area. I press once again in red area with left click. So now, right now, I'm having in my trade $12. This is my entry point. Okay, and this is my profit or my loss. Right now I am minus 0.038%. Okay, so what you see inside the trade, here you can see how much you entered. As I said, $12, for example, right? our stop loss and take profit. Right now I'm on loss because it's red. When it will be green, I will be in profit. Okay, so we are just waiting. We don't do anything anymore. We have everything. Take profit, stop loss. Just wait. We are just waiting, nothing else. What you can do, let's go through the hotkeys. I will tell you about hotkeys, some of them, okay? Do you remember when we were going through our exiting algorithm, when we will start taking profit, I told you that when the price will reach plus 0.8, we have to move our stop to break-even entry. What is our entry point? As I said, this is the price where our entry point is. So, and you can see it here as well. You see there is it's like a blue line here. So this is our point, entry point. So in order to move our stop loss to the break-even, there is a hotkey. It's C. If you press C, button C, you see what it says here, stop loss, take profit. So right now I hold this C key and I can move my stop loss wherever I want. For example, I want to put it right here. I just hold it. It should be written here. I just hold it and press with left button wherever I want. Hop, you see, it's moved up here. Then I want back here, I moved it down here. And the same way you do with the take profit. So if I press this button, I can move my take profit up here, down here. That's very easy actually. Then just leave the button, that's all. As well, you can place a level, not like here we did on the chart, but you can place the level straight in the order book. How to do that? You press letter L. You see, user level, L. And for example, I want to put it here. You see, there is a level. And if you look at the chart, you will see this level over here. You see, it appears, this one, and it disappears. So like this, sometimes it's very useful. Actually, right now we don't do anything because we're just sitting and waiting, right? So stop loss part is quite clear, right? If the price reaches the stop, the trade closes. If the price reaches the take profit, the trade also closes. Okay, so according to the profit taking algorithm, we wait until the position shows over here plus 0.4, and then we will lock in part of it. Okay, how do we do that? There is a $6 here, we have 12, so that's okay. In order to lock in part of the position, we need to, right now we are in long position, so we bought $12. So right now, in order to fix profit, I need to sell some of it. So how to do that? We just need to press right button in green area, and it will sell $6 because I have here $6. If I put here 150, it will be 150. $6. I need just $6. Okay. About Bitcoin, also you notice that I have two order books here and charts because I always control the movement of Bitcoin. If you look at 1 minute of the asset, so you should put the Bitcoin also 1 minute time frame. Why? Because we need to watch the correlation with Bitcoin. If Bitcoin goes up, the asset often goes up too. If Bitcoin goes down, the asset often goes down. That's correlation. And yes, of course, there are assets which are decorrelated with Bitcoin, but that's another story. That's completely another story. Okay, so there is one magic button also here. If you want to close the trade immediately, for example, if you are nervous, you can't handle it, that's not a problem actually. Don't be nervous. What you just need to do, you just need to move your mouse over the order book, that's important, here, and press D. The position will close completely. If your mouse will be here, it won't close, it won't work. It's extremely important to be here. Just press D and that's all. All the position will close completely. Okay. One more important for the future, actually, for connections, when you choose an asset, use please Bybit PST School. But you will see it in my settings video. So we have, you see here, PST School Binance USDM. And the same way you will have PST School Bybit USD. And the third connection you will have separate Binance View Mode. And that's usually we watch Bitcoin, movement of Bitcoin. You see just Binance USDTM. Okay, if anything is unclear, don't worry, we will post everything. I told you I will post it. Video, everything. Okay, I will send this lesson as well, homework, how to connect to trader diaries, so don't worry. But anyhow, if you still have questions, we are around, we will help and we'll walk you through it. Okay. Okay. So, okay, let's imagine that, because we will wait for a long time, actually, let's imagine that here it's already plus 0.4. I want to fix I want to fix one of part of the position. Okay, how do we do that? We just need to, you move your mouse over the green area and you press right button. Okay, let's wait a little bit. Right now actually it's in our zone, we can buy more. You see, right now I have $18. But you see what's happening here on Bitcoin. Bitcoin is going down, so ADA actually is very correlated with Bitcoin, so right now it can go much down. Okay, that's no problem, because we have a stop loss set for 1.6, so I'm absolutely comfortable with this stop loss, and I don't worry about it. I just wait. Okay, I want to tell you about zone which is 0.6%. How do we do that? Actually, we need to place okay, let's see now the zone 0.6. You have to, as we said before, on Bybit you can put, for example, if you're decided to enter the trade $20 full deposit. You put your stop loss 0.8% and you split your trading size by 4 parts, excuse me. So that's $2 4 times, right? 4 orders. On Binance, it's $6. This is the minimum lot size. That's why I will put 2 times $6, for example, or 3 times $6. Okay, so the same way we mark our zone 0.6. Let's say from here. This is our zone 0.6. You see how wide it is, but it's on 1 minute time frame. So now in this zone I have to put, for example, if I want to enter 50% of my deposit, let's say 12, because it's 6 minimum lot. Okay, so 2 times $6. I have to split this area in 2 and put the limit orders. So how to put, if I want to go, for example, long, how do I do that? You can see this is my 0.6 area from here and till here. This is my area. So how do I put in long? I just click with left button of the mouse the price where I want to put my limit order. For example, I want to put it here. I just click it and you see there is a limit order of $6 here. And for example, I put it here. These 2 limit orders, when the price will reach it, it will take it and I will enter the trade. Okay, so if I go short, the same way I put limit orders for sell. So I press in red zone, I press right click and put limit order for selling. That's how to put limit orders in order book. It's actually it's very easy. You just need to get used to it. Okay, a little bit confusing, but you have to try. Okay, let's one more time on mechanics. So if we are trading a long position, we press left mouse button. We were buying inside the red zone. Okay, left mouse button, red zone, right mouse button, selling, and it's in green zone. Okay, so you have to just remember this. Okay, let's leave this trade like this and let go back to our chart. Actually, I want to show you one more thing. I want to draw actually one more thing. Let's go somewhere down here. So today we are working with a bounce strategy. Yeah, let's try draw it like this. Let's say we have very good movement. We have 2 strong levels of support and resistance. For example, there is a consolidation here. And it's again going down after that. Then this, again, we have consolidation here. So I just want to recap a little bit. So this is a level of support, the green one. This is the level of resistance. Okay, and the asset moves between them. If it comes to the level, consolidates there, and the level is being defended, so we trade the bounce short here. So from here we go short. This is short. You go down. Okay, if it consolidates down here at support level, so it bounces long. This is long position. I think for now your task actually is simple. You have to find a strong levels and try trading it and see how it works out for you, okay? So I think this is not that difficult. The only thing which is a little bit confused, it is this part. So, but you only have to try. There is nothing difficult. You just you need to get used to this buttons, which button for which zone, how to put market orders, how to place stop loss, how to move it. So it's just a practice and nothing else. Okay, so in the end, I want to say again, you have a shared account with $21. You will have an instruction how to connect to Trader's Diary and to Terminal. Don't worry about that. I will send all the pictures with hotkeys. If you have questions, write it into the group. Okay, so please just trade, send your homework, and we will review everything. And the most important thing, guys, please strict structure and strict risk management. That's very important. That is the foundation of foundation. Okay, so what else I want to say in the end, actually? Our intensive has come to an end. Actually, we have covered the core of phase trading. We learned how to work with accumulation zone and practiced strict risk management. Okay, so remember, very important thing, the market does not forgive haste, but it rewards discipline. Now, it's up to you to turn this knowledge into skill or not. What would I say? I would say, I wish you all mindful trades and consistent profits. And I hope we will meet again. We will have many free intensive in the future. So please turn into our main group. We will have all the information over there. And I was very glad to see you with me these 2 days. Thank you very much for coming. And well, see you in the chat. Bye bye, everybody.